Okay, so you want to own a beauty salon. Find a nice space, put up some mirrors, hire a few stylists, and watch the money roll in every time someone sits in a chair. And from the outside, it makes complete sense. People pay for haircuts every few weeks. Coloring appointments run into the hundreds of dollars. The same chair can theoretically be filled 10, 12 times a day. Repeat customers, high prices, a service that never goes out of style. What could go wrong? Quite a lot, actually, because when you follow that money all the way from the customer's wallet down to what the owner actually takes home, the picture changes dramatically. And the reason it changes comes down to one word: labor. Before we get there, though, let's talk about what you are actually buying when you decide to own a salon. You are not just buying mirrors and chairs. You are buying a physical location with foot traffic and neighborhood visibility. You are buying equipment, styling stations, shampoo bowls, high-powered dryers, facial units, nail stations. You are buying a brand, a reputation, relationships with existing customers, and a team of people whose skills are what generate the revenue in the first place. You are buying a system that is supposed to repeatedly convert appointments into cash. And here is where the first uncomfortable reality shows up. Industry analysis has found that in up to 90% of small salons, the business only looks profitable because the owner is personally cutting hair, doing color treatments, and performing services themselves. Remove the owner from behind the chair, pay a replacement stylist at market rate, and a large portion of those salons would be running at a loss. That is not a business. That is an expensive job that happens to have a storefront attached to it. A salon that relies entirely on employees to generate revenue is a different animal. It can scale, it can grow, but it also has to manage payroll for an entire team, carry the risk of slow weeks, and operate on margins that are much thinner than most people expect. So before we even talk about profits, let's talk about what it costs to get the doors open. Getting a full-service salon up and running is not a small check. The physical build-out alone, plumbing for shampoo stations, electrical upgrades for high-wattage drying equipment, custom cabinetry, flooring, lighting, regularly runs between $150,000 and $450,000 for a space with 12 to 15 chairs. That number shifts depending on the city, the size of the space, and how premium the interior needs to feel. A modest neighborhood salon in a mid-sized market is going to cost far less than a luxury concept in a high-rent urban corridor. On top of the build-out, you have the chairs themselves, the stations, the shampoo bowls, the mirrors, the reception desk, the point-of-sale system, the booking software, the signage, the licensing and permits, the initial chemical inventory, the insurance, and the marketing to let people know you exist. All of that adds up before you have served a single customer. And here is the mistake that kills a lot of new salon owners before they even get started. They budget enough money to open. They do not budget enough money to survive until customers arrive. A salon does not walk out the door on opening day with a full appointment book. Building a client base takes months. During those months, rent is due, salaries are due, software subscriptions are due, utilities are due. The business needs a working capital cushion, typically $50,000 or more, just to absorb the losses during the ramp-up period. Run out of that cushion before your chair utilization stabilizes, and you are done before you ever really started. Now let's talk about location, because this decision has more financial consequences than almost anything else you will choose. A cheaper location reduces your fixed monthly rent, but it also reduces how many people walk past your window, how many people discover you by accident, and how much you can reasonably charge for a haircut. Lower foot traffic means you have to spend more money on advertising to bring customers in. A cheaper location can end up costing just as much, or more, once you account for the marketing spend required to compensate for the invisibility. A premium location, higher rent, better street presence, more affluent neighborhood, does the opposite. It charges you more every month whether you are busy or not, but it signals quality, attracts customers who expect to pay more, and lets you set prices that reflect that positioning. The target that solvent salon operators aim for is keeping their total occupancy cost, rent, maintenance fees, property taxes, and utilities combined, between 10 and 15% of gross revenue. If rent alone is eating 20% of what you bring in, the math becomes very hard to survive. A useful measure of whether your space earns its keep is revenue per square foot. A well-run 2,000 square foot salon with 12 to 15 chairs should reach around $500 per square foot annually by year 3. Roughly $1 million in total sales. Top performers push toward $1,200 per square foot. Miss those numbers, and your space costs more than it produces. Now let's get into the economics of the actual service. The chair is the revenue machine. If a stylist can complete 4 to 6 clients a day, and the salon has 12 chairs open 6 days a week, you can calculate a rough ceiling for what the salon is capable of producing. But that ceiling only exists on paper. The number that determines your financial reality is utilization, the percentage of available chair time that is actually booked and occupied. A chair that is empty is not just producing zero revenue. It is actively costing you money. The rent, the utilities, the insurance, those bills run whether anyone is sitting in that chair or not. An empty slot at 2 in the afternoon on a Tuesday cannot be sold again. That time is gone. This is why scheduling is not an administrative task in a salon. It is a core financial function. Every no-show, every last-minute cancellation, every slow Wednesday morning, those are direct hits to the bottom line. Let's follow $100 from a customer's hand to the owner's pocket, because that journey is where most people's assumptions about salon profitability fall apart. A customer comes in, gets a service, pays $100. That $100 does not belong to the owner. Here is roughly where it goes. Between $40 and $45 goes to the stylist who performed the service. That is direct labor, the biggest single expense in the building. Between $5 and $8 goes to chemical products consumed during the service. Around $2 to $3 goes to credit card processing fees. $10 to $12 go toward rent and occupancy costs. $2 to $3 cover software. $3 to $4 cover utilities. $3 to $5 go toward marketing. Another $5 to $7 cover administrative costs, payroll taxes, insurance, and accounting fees. After all of that, the owner is left with somewhere between $8 and $12 out of that original $100. 8 to 12 cents on every dollar. That is the average net profit margin for a well-run full-service beauty salon. Not 30%, not 20%, 8 to 12%. And that is a healthy margin in this industry. Now you understand why labor is the central economic problem of the salon business. Labor eats 35 to 50% of every dollar that comes in. How you structure your compensation model shapes almost every other financial outcome in the business. The most common model is commission-based pay. A stylist earns somewhere between 40 and 60% of the revenue they personally generate. The upside for the owner is that payroll automatically scales down during slow periods. If the salon has a quiet week, commission expenses fall alongside revenue. The downside is that during busy periods, the owner is giving away half of every dollar coming through the door. Some salons pay fixed hourly wages or salaries instead. This makes financial planning easier but puts the entire risk on the owner's side. If the appointment book is empty, those wages are still due. A third model is booth rental. The stylist is not an employee at all. They pay the salon owner a flat weekly fee, typically between $250 and $500, to use a chair in the salon space. The owner becomes a landlord. The risk of slow periods shifts to the stylist. Income is more predictable, but the upside is capped. The owner does not benefit when a stylist has a record month. The hidden trap in the commission model is talent management. A stylist who builds a loyal personal following quickly realizes that their client book belongs to them, not to the salon. That stylist can walk out the door, sign a booth rental agreement down the street, take their clients with them, and the salon loses 30% of its revenue overnight while the rent bill stays exactly the same. This is one of the most common ways a profitable-looking salon suddenly becomes a struggling one. Speaking of hidden traps, let's talk about what an empty chair actually costs. There is a significant financial difference between a salon operating at 50% chair utilization and one operating at 90%. Both pay the same rent, both carry the same insurance, both run the same software subscriptions. The salon at 90% utilization is spreading those fixed costs across far more revenue, which means each dollar of revenue carries a much smaller burden of overhead. The salon at 50% is paying full overhead on half the potential income. The math on this is brutal. Benchmark data shows that when clients rebook just once without any structured follow-up, the cancellation rate for future appointments can reach 72%. But clients who are enrolled in a structured rebooking system with automated reminders and confirmation messages maintain cancellation rates of around 4%. Automated scheduling and reminder platforms have been shown to reduce no-shows by an average of 32%. That is not a technology upgrade. That is a direct profit improvement. Now, not every service on your menu is equally valuable. This is a point that surprises most people who think about salon economics. A service is not better just because it has a higher price tag. What matters is how much revenue that service produces per hour of chair time, what operators call revenue per labor hour. Here is a real example. A full hair coloring treatment priced at $180 sounds like a great ticket, but that service takes 3 hours, and the chemical products for the application cost about $35. After subtracting the product cost, you have generated $145 across 3 hours of chair time, roughly $48 per hour. Now compare that to a precision haircut priced at $70, taking 45 minutes and consuming about $2 in supplies. That service generates $68 of net service revenue in 3/4 of an hour, roughly $90 per hour of chair time. The $70 haircut produces nearly double the hourly value compared to the $180 color treatment. The color treatment is not bad, it brings in more absolute dollars per visit and tends to create strong client loyalty. But the haircut is far more efficient. Managing your service menu with this kind of thinking in mind changes which services you promote, which ones you train for, and how you fill your schedule. If you're finding this breakdown useful, take a moment to subscribe to the channel and give this video a like. It genuinely helps more people find content like this. Now, most salons are not just doing hair. They have expanded into nails, skincare, facials, waxing, lashes, brows. Each of those categories has its own economics. Nail services have low ticket prices but high visit frequency. Customers return every 2 to 3 weeks. Margins run 40 to 60%, and the repeat nature of the revenue is valuable. The catch is that nail sections require ventilation, dedicated space, and sometimes separate licensing. Skincare and facials carry margins of 50 to 65%, and customers who come in for facial are highly likely to also buy retail skincare products on the way out. That combination makes facial clients some of the most productive customers in the building. Eyelash and brow services carry some of the highest percentage margins in the salon, 60 to 75%, with repeat cycles of 2 to 3 weeks. The constraint is that they require specialized technicians and are intensely labor-dependent. Adding more services sounds like an obvious growth move. More reasons to visit, more revenue streams, more customers. But more services also means more equipment, more specialized staff, more inventory to track, more training costs, and a more complex operation to manage. Complexity has a cost. Adding a nail section to a hair salon is not just adding a revenue line. It is adding a mini business inside your business. Let's talk about the product shelf, because this is where smart salon owners find a financial advantage that most people overlook. Retail products, shampoos, conditioners, treatments, skincare carry gross margins of 40 to 50%. And a retail sale does not require the stylist's time after the recommendation. The customer buys the product, takes it home, runs out, and comes back. You have monetized the relationship beyond the chair. The average salon generates 8 to 15% of total revenue from retail. The best performers push that to 20 or 25%. At $1 million in annual revenue, the difference between 9% retail and 20% is more than $100,000 in additional high-margin income. The risk is inventory management. Products expire. Some items move fast. Others sit on the shelf for months tying up cash. The salon that never audits what is actually selling slowly bleeds working capital into stagnant stock. Now let's get into the customer math, because this is where the real long-term economics of the business live. A customer who comes in once for a $200 service and never returns is worth $200. A customer who spends $75 per visit, comes in 8 times a year, and stays for 5 years is worth $3,000, 15 times more valuable than the one-time spender. Industry data shows that 42% of a salon's loyal recurring clients generate 80% of total revenue. Keeping existing customers coming back is far more financially valuable than constantly hunting for new ones. But acquiring new customers costs money. Salons spend on Instagram ads, Google campaigns, influencer partnerships, first visit promotions, and referral programs. The question is not whether you are spending on acquisition, it is whether that spending is producing customers who stay long enough to justify the cost. A new client acquired for $60 is a great investment if she returns every 6 weeks for 3 years and buys products at checkout. She is a terrible investment if she used a first visit discount, came once, and never came back. This is why deep introductory deals often damage salon economics. Customers attracted by a big discount tend to be price sensitive with no loyalty to your salon. Once the deal is gone, they go wherever the next deal is. You spent real money acquiring someone who was never going to become part of your recurring revenue base. Discounting has a legitimate place in salon strategy. Filling slow Tuesday morning slots with an incentive price is smart. But running permanent discounts as the primary reason people visit creates a structural problem. The rent does not discount. The salaries do not discount. The insurance does not discount. When you cut your price by 10%, you have cut pure revenue while every single fixed cost stays exactly the same. The math is stark. On a $100 service with $60 in variable costs and $30 in allocated fixed overhead, the salon nets $10, a 10% margin. Cut the price to $90 while costs stay unchanged, and that $10 of net profit becomes zero. A 10% price reduction wipes out the entire net margin. To recover in volume, the salon would need to double its appointment count, twice the labor, twice twice the product use, twice the wear on equipment, to make the same amount of nothing. The premium pricing argument runs in the opposite direction. Raising prices even modestly has a disproportionately positive impact on net profit because fixed costs stay unchanged. On that same $100 service producing $10 in profit, a 5% price increase raises the ticket to $105. After accounting for a small commission on the extra revenue, net profit rises to around $13. A 30% improvement in owner earnings from a 5% price change. Salons that invest in better training, more consistent service quality, stronger branding, and an elevated customer experience earn the right to charge more for the same appointment. And when they do, almost all of that additional price flows straight to the bottom line. Let's talk about the break-even point, because understanding this number is the difference between a salon owner who knows their business and one who is just hoping for the best. Every salon has a certain level of monthly fixed costs, expenses that do not change regardless of how many customers walk through the door. Rent is fixed, software subscriptions are fixed, insurance premiums are fixed, administrative salaries are fixed. These costs exist whether the salon books 0 appointments that month or 500. Variable costs move with revenue. Commissions, product consumption, payment processing fees. The break-even point is the exact revenue level at which the salon covers all of its costs and makes exactly 0 profit. Every dollar above that level starts producing profit. Every dollar below it means the owner is losing money. Here is how the numbers work. Suppose fixed monthly costs total $18,000. The average ticket is $85. Variable cost per appointment, commission, product, processing, averages $45. Each booking contributes $40 toward covering fixed costs. Divide $18,000 by $40 per appointment. The break-even point is 450 appointments per month. Roughly 22 appointments every single operating day, just to stop losing money. Not to profit, just to survive. Any salon owner who does not know their break-even number is flying blind. Now let's talk about what the owner actually makes. Not revenue, not gross receipts, but the money that ends up in their personal account. There is an accounting error that runs through much of the beauty industry. Owners who work behind the chair count their personal service income as business profit. But if you remove the owner from the floor and paid a market rate stylist to do that same work, those earnings disappear from the business immediately. An owner earning $90,000 while working 40 hours a week behind a chair is not running a $90,000 profit business. A replacement stylist doing that work might cost $70,000 in wages and payroll taxes. The actual enterprise profit could be just $20,000. A genuinely profitable salon should eventually generate positive returns without requiring the owner to personally hold the scissors. That is the transition from buying a job to owning a business. Most small salon owners never fully make that transition. Let's talk about what can go wrong. Salons rarely fail in a sudden dramatic collapse. They fail slowly, through a series of compounding problems that each look manageable on their own. The most dangerous single event is losing a top stylist. If one person is generating 30% of the salon's revenue and they leave, for a booth rental suite, another salon, their own space, they take their client book with them. Revenue drops 30% immediately. The rent does not drop. The remaining wages do not drop. The owner is suddenly covering the same fixed cost structure on dramatically less income. Lease renewals are another landmine. A salon that negotiated a below-market rent 5 years ago may face a dramatically different number at renewal. A rent increase that pushes occupancy costs from 8% to 15% of revenue can turn a healthy operation into an underwater one overnight. Unmonitored inventory creates slow hemorrhaging. Chemical waste in the mixing bowl, too much color mixed for a formula, excess product discarded, adds up to thousands of dollars a year in unnecessary product cost. Theft, rarely discussed, is also a real factor in retail inventory. And then there is the quiet killer, customer churn. In an era where clients book through Instagram and leave reviews on Google, a salon that lets service quality slip quietly loses customers who never say a word. They simply do not rebook. Because attrition is gradual, the owner often does not recognize the severity until chair utilization has already dropped below the break-even threshold. Now, can a salon actually scale beyond one location? In theory, yes. A successful salon concept can expand to multiple locations. Some operators have built regional chains with 5, 10, or more sites. But every additional location adds rent, payroll, management, training costs, and quality control challenges before the new site has built the clients needed to cover its own overhead. The mistake most owners make when opening a second location is thinking they are copying their salon. They are not. They are trying to copy the operating system that made the first one work, and that system is much harder to duplicate than the floor plan. Let's look at what this all looks like at scale. Imagine a salon generating $1 million in annual revenue. That sounds like a strong business. But subtract the expense categories one by one, and here's what happens. Staff compensation and payroll taxes consume $480,000, 48% of revenue. Rent and occupancy takes $120,000. Processing fees $30,000, marketing $50,000, software $25,000, utilities $35,000. Administrative, legal, and insurance costs $55,000. Chemical products and inventory $85,000. Total expenses $795,000. Net profit $35,000. On $1 million in revenue, the owner of that salon, if it is unoptimized, is keeping $35,000. That is 3.5%, but now look at the same $1 million through an optimized operation. Better management of commission structures brings labor costs down to $400,000, 40% of revenue instead of 48%. A more favorable lease negotiated over time drops rent to $80,000 instead of $120,000. Retail sales are actively pushed to 20% of revenue instead of 9%, adding high-margin income. Automated scheduling reduces no-shows, boosting utilization without adding chairs. The optimized salon generates $145,000 in net profit on the same $1 million in revenue. Not because it served more customers or charged more for haircuts, but because it ran the operation more precisely. The difference is $110,000. From the same top-line revenue, there is not one single correct way to own a salon. The economics depend entirely on which model you are running. A high-volume, lower-priced salon competes on convenience and speed. Tickets might average $30 to $50, but the appointment book is full from open to close. Margins per transaction are narrow, but volume keeps the chairs occupied and the fixed costs covered. A premium luxury salon charges $150 to $350 or more for appointments. Lower customer count, far higher revenue per visit, a clientele that expects a premium experience and is largely insensitive to price increases of 5 to 10%. The risk is that this model depends heavily on maintaining an exceptional reputation and retaining the specific stylists that those high-value clients are loyal to. The booth rental model operates differently from both. The owner collects fixed weekly rent from independent stylists. The revenue is predictable. The payroll risk disappears, but the owner is now in the commercial real estate business as much as the beauty business. The upside is capped by how many chairs the space holds. None of these models is inherently superior. The best model is the one that fits the owner's risk tolerance, skill set, capital position, and market. So is owning a beauty salon actually worth it? Before you answer that, take a moment. If you want to keep learning how businesses actually work from the inside out, check out the detailed business guide linked in the description and pinned in the first comment. It covers the kind of frameworks that make the numbers in this video actually actionable. The answer is, it depends on how intelligently the system is built. A salon becomes a genuinely attractive business when clients are retained at high rates, chairs are utilized consistently above 75%, labor costs are kept between 35 and 45% of gross revenue, pricing reflects the quality of the experience being delivered, and retail sales are actively generating a second revenue stream alongside services. It becomes a financial trap when the owner's personal labor is the only thing making the numbers look positive, when stylists cycle through and take their clients with them, when pricing is chronically discounted, when fixed costs have crept above what the revenue base can support, and when the owner is watching revenue as a success measure instead of the 8 to 12 cents on every dollar that actually determines whether the business is viable. The chairs are not the asset. The mirrors are not the asset. The lease is not the asset. The asset is the loyal client base that keeps coming back. Combined with the team that serves them well and the operational system that converts those relationships into reliable, recurring cash flow month after month. When a customer pays $100 at a beauty salon, how much does the owner actually keep? Between $8 and $12 in a healthy, well-managed operation. In an unoptimized one, far less, sometimes nothing. But in a disciplined salon with strong retention, controlled labor economics, active retail sales, and smart pricing, that $12 compounds across hundreds of chairs and thousands of appointments into something genuinely valuable. Not a demanding job with a storefront, a real business. If you found this video valuable, please give it a like and subscribe to the channel if you haven't already. It helps us keep making content like this. Thanks for watching.